Preparing for FP&A Analyst at National Grid interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A do, and why is it important at National Grid? FP&A turns operational information into financial insight and forward-looking decisions. At National Grid, that means coordinating budgets, updating forecasts, explaining performance, and helping leaders balance investment, affordability, reliability, and returns. I would connect financial outcomes to drivers such as customer demand, weather, labor, maintenance, project delivery, and regulatory allowances. The role is not simply reporting history. It is identifying risks early, challenging assumptions constructively, and recommending actions that improve both financial performance and network outcomes. While answering, focus on planning, forecasting, performance analysis, decision support, regulated utility economics, capital intensity, operational reliability, and how finance partners with engineering and commercial stakeholders. Question 2. Why do you want to work for National Grid as an FP&A analyst? I want to join National Grid because its financial decisions directly support essential infrastructure and the transition to a lower carbon energy system. That creates a meaningful FP&A environment. Capital allocation must be disciplined, but investment also supports reliability and future capacity. My strengths in financial analysis, Excel, communication, and attention to detail fit the role. I am particularly attracted to partnering with operational teams, understanding the drivers behind performance, and developing forecasts that leaders can confidently use. Make sure to cover National Grid's critical infrastructure role, energy transition, regulated environment, analytical learning opportunities, stakeholder exposure, and a specific connection between your skills and the position. Question 3. Walk me through how you would prepare an annual budget for a utility business. I would begin with strategic priorities, regulatory commitments, and the latest forecast, then establish clear planning assumptions. I would gather bottoms-up inputs from asset, operations, HR, procurement, and project teams, separating fixed costs from driver-based items. For National Grid, I would model capex, maintenance, labor, demand, inflation, financing impacts, and regulatory mechanisms. I would challenge unusual assumptions, reconcile submissions to the general ledger, document versions, obtain approvals, and create monthly phasing for meaningful variance analysis. In your answer, talk about strategic objectives, bottoms-up inputs, historical trends, operational drivers, regulatory assumptions, capital and operating expenditures, challenge sessions, approvals, and version control. Question 4. How would you build a monthly forecast for National Grid? I would start by loading validated actuals and comparing year-to-date performance with the approved budget. I would then forecast the remaining months using operational drivers rather than applying a simple straight-line assumption. Those drivers could include weather, customer volumes, labor vacancies, contractor activity, commodity prices, and project milestones. I would meet budget owners to refresh assumptions, quantify upside and downside scenarios, review phasing, and present a concise bridge from the previous forecast to the new outlook. Be sure to mention actuals to date, remaining month assumptions, driver-based modeling, seasonality, project milestones, latest operational intelligence, scenario analysis, and clear ownership of assumptions. Question 5. How do you explain a budget variance to a non-finance stakeholder? I explain the variance through its business cause, not just its accounting label. For example, I might say contractor costs are £2 million above plan because a maintenance program accelerated, while clarifying whether that is timing, scope growth, or inefficiency. I would quantify the impact, compare it with the latest forecast, and explain the expected full-year effect. Then I would agree actions with the stakeholder, such as rephasing work, updating assumptions, or escalating a structural pressure. Focus on translating accounting results into operational causes, separating timing from permanent effects, quantifying material items, avoiding jargon, confirming facts with owners, and ending with an action or outlook. Question 6. What is the difference between a budget, forecast, and actual result? A budget is the approved financial plan established before the period, usually reflecting strategic priorities and agreed resource levels. A forecast is the best current estimate of what will actually happen, updated as conditions change. Actuals are the transactions and results recorded in the accounting system. FP&A compares actuals with budget to assess accountability and compares them with forecast to identify emerging changes. The forecast should be honest and dynamic, not adjusted merely to make performance look favorable. Make sure to distinguish the approved financial plan, periodically updated expectation, and recorded performance, while explaining how FP&A uses variances among them to improve decisions. Question 7. How would you analyze an unfavorable operating expense variance? I would first validate the variance against the ledger and confirm it is material rather than a coding issue. Next, I would decompose it by cost center, account, supplier, and month, then identify whether the cause is price, volume, timing, scope, foreign exchange, or a one-off. I would discuss the result with the budget owner, determine whether the pressure is controllable or structural, update the forecast, and recommend an action with a named owner and deadline. In your answer, cover materiality, account and cost center review, price volume mix or rate drivers, timing, one-offs, controllability, forecast impact, and management actions. Question 8. How would you evaluate a major capital project that is over budget? I would compare the approved baseline with actual spend, purchase commitments, remaining scope, and the revised estimate at completion. I would separate cost overruns from timing shifts and investigate causes such as design changes, contractor claims, inflation, delays, or inadequate contingency. I would also assess schedule impact, regulatory commitments, safety implications, and expected benefits. The recommendation might involve reforecasting, scope control, contingency approval, or escalation through project governance rather than simply accepting the overrun. Be sure to mention approved baseline, committed and incurred costs, estimate at completion, schedule variance, change orders, contingency, benefits, governance, and escalation thresholds. Question 9. What financial metrics would you monitor for National Grid? I would monitor revenue, EBITDA, operating cost, capex, operating cash flow, free cash flow, net debt, and leverage, while connecting them to operational measures. For a utility, I would also track regulatory performance, allowed versus earned returns, project delivery, reliability, customer service, and safety indicators. The most useful dashboard would show actual versus budget and forecast, trends, drivers, and risks. Metrics should support decisions, so I would avoid presenting ratios without explaining what management can do about them. Focus on revenue, EBITDA, operating costs, capex, cash flow, leverage, regulatory returns, project delivery, service quality, and linking financial measures to operational and customer outcomes. Question 10. How do regulated utility businesses affect FP&A analysis? Regulation makes the relationship between operations, revenue, and returns more structured than in many industries. National Grid's planning must consider allowed revenues, approved investment, recoverable costs, incentive mechanisms, and regulatory reporting requirements. Some economic benefits or costs may be recognized over different periods, creating timing differences between accounting results and regulatory recovery. I would therefore understand the regulatory framework, identify assumptions that drive allowed returns, and ensure forecasts explain both financial performance and regulatory progress. While answering, cover allowed revenues or returns, regulatory settlements, price controls, recoverable costs, incentives, timing differences, and the importance of separating accounting performance from regulatory performance. Question 11. How would weather affect a National Grid forecast? Weather can materially influence energy demand, especially through heating and cooling patterns. I would analyze historical relationships between weather variables and volumes, compare current conditions with normal levels, and quantify the resulting revenue or cost sensitivity. I would use regional and business-specific assumptions rather than one blanket adjustment. The forecast would include a base case and weather-related sensitivities, while separating temporary effects from underlying changes in customer numbers, efficiency, distributed generation, or usage behavior. Make sure to cover demand sensitivity, heating and cooling patterns, normalization, regional differences, historical data, scenario ranges, and distinguishing temporary weather effects from underlying customer trends. Question 12. Describe a time you improved a reporting or forecasting process. In a previous role, monthly reporting required several manual spreadsheet consolidations and often produced inconsistent cost center mappings. I created a standardized template with controlled inputs, lookup tables, validation checks, and a reconciliation to the ledger. I documented ownership and introduced a short review checklist before submission. The process reduced preparation time by approximately 30% and eliminated recurring mapping errors. More importantly, analysts spent more time explaining drivers and less time correcting data, improving the usefulness of management discussions. In your answer, use a clear situation action result structure, quantify time or accuracy improvements, explain stakeholder adoption, and mention controls that preserved data quality. Question 13. Which Excel skills would you use in this role? I would use SumIfs and XLOOKUP or index match for controlled data retrieval, pivot tables for rapid analysis, and structured tables to keep models scalable. For forecasting, I would build driver-based schedules with scenario toggles and clearly separated inputs, calculations, and outputs. Power Query can reduce repetitive data preparation, while charts and bridges communicate results. I also include error checks, balance tests, sign conventions, and reconciliation controls, because a sophisticated model is not useful if users cannot trust it. Be sure to mention SumIfs, XLOOKUP or index match, pivot tables, data validation, scenario tools, charts, error checks, Power Query, and building transparent models rather than overly complex formulas. Question 14. How would you use Power BI or another reporting tool in FP&A? I would use Power BI to create a reliable management view of actuals, budget, forecast, and operational drivers. First, I would establish consistent definitions, connect authorized data sources, and validate totals against the general ledger. Then I would build pages for executive trends, business unit variance analysis, and drill down by cost center or project. Automated refreshes would reduce manual effort, while role-based access and documented ownership would protect data. The dashboard should answer why performance changed and what action follows. Focus on data model integrity, automated refreshes, consistent definitions, interactive management views, drill-down capability, security, and using visualization to answer decisions rather than decorate reports. Question 15. How do you ensure accuracy in financial reporting? Accuracy starts with understanding the source data and the accounting process behind it. I reconcile reporting outputs to the general ledger, investigate unusual movements, check period cutoff and sign conventions, and compare results with operational evidence. I use locked formulas, controlled inputs, version naming, and documented review procedures. Before issuing a pack, I perform reasonableness checks against prior periods and forecast expectations. If something remains unclear, I flag it transparently rather than presenting false precision. Mention reconciliations, source validation, reasonableness checks, period cutoff, version control, review evidence, segregation of duties, and investigating exceptions before communicating results. Question 16. Tell me about a time you challenged a senior stakeholder's assumption. A senior stakeholder once assumed a cost reduction would recur every month after a single favorable result. I reviewed the underlying invoices and found that the benefit came from a one-time timing difference, not a sustainable efficiency. I presented the evidence clearly, acknowledged the genuine opportunity, and proposed a smaller recurring saving plus a separate timing adjustment. The stakeholder accepted the revised forecast because the analysis was objective and solution-oriented. I learned that good challenge protects credibility while preserving partnership. In your answer, demonstrate respectful challenge, evidence-based analysis, commercial judgment, listening, an alternative recommendation, and a positive outcome without sounding confrontational. Question 17. How would you prioritize competing deadlines during the month-end cycle? I would map deadlines, dependencies, and risk at the start of the cycle, prioritizing activities that affect external reporting, executive decisions, or other teams' work. I would complete data requests with long lead times early, maintain a visible tracker, and communicate immediately if a dependency threatened delivery. For urgent requests, I would clarify the decision required and provide a reliable interim view if appropriate. I would never remove essential validation without escalating the trade-off and agreeing the risk. Focus on materiality, statutory and management deadlines, dependencies, early communication, task planning, escalation, quality controls, and protecting time for review rather than completing tasks sequentially without judgment. Question 18. How would you perform a revenue forecast for National Grid? I would decompose revenue into its main drivers: customer numbers, volumes, tariffs, regulated allowances, connection activity, and other commercial income. I would incorporate approved price changes, weather sensitivity, business mix, timing of settlements, and any bad debt assumptions. I would reconcile the model to historical actuals and the general ledger, then build a bridge from the prior forecast showing volume, price, mix, and other movements. Finally, I would test downside scenarios for demand, regulation, and collection performance. Be sure to cover customer or energy volumes, tariffs, regulated allowances, weather, pricing changes, timing, bad debt, business mix, and reconciliation to prior forecasts and actual trends. Question 19. What is the difference between capex and opex, and why does it matter? Capex is spending that creates or enhances an asset and is generally capitalized, then depreciated over its useful life. opex supports current period operations and is expensed as incurred. The distinction matters because it affects profit timing, asset balances, depreciation, cash planning, and potentially regulatory recovery. I would not classify costs based on desired performance. I would apply accounting policy, assess the nature and benefit of the expenditure, and involve controllership when judgment or project complexity makes the treatment uncertain. Explain capitalization versus expensing, asset creation or enhancement, useful life, depreciation, cash timing, budget governance, regulatory treatment, and the importance of applying accounting policy consistently. Question 20. How would you assess whether a forecast risk is material? I would assess both magnitude and decision relevance. A risk may be material because of its effect on EBITDA, cash flow, capital delivery, leverage, regulatory commitments, or customer outcomes, even if it is small relative to total revenue. I would estimate probability, timing, potential range, and management's ability to mitigate it. Then I would compare the result with established thresholds, run sensitivities, document assumptions, and escalate clearly. Materiality is not only a percentage, it is the potential to change a decision. In your answer, discuss quantitative thresholds, earnings and cash impact, likelihood, timing, controllability, strategic or regulatory consequences, scenario analysis, and escalation based on decision relevance. Question 21. What would you include in a monthly management pack? I would include an executive summary of the key messages, followed by actual versus budget and forecast for revenue, costs, EBITDA, capex, and cash where relevant. Variance bridges should identify the operational drivers, not merely list accounts. I would show KPI trends, project delivery, risks, opportunities, and the updated outlook, using consistent definitions and clear commentary owners. The final section should state recommended actions and decisions required. A good pack is concise enough for executives but traceable enough for follow-up. Mention executive summary, actual versus budget and forecast, key bridges, KPI trends, cash and capex, risks and opportunities, outlook, commentary ownership, and concise recommendations for action. Question 22. How do you approach scenario analysis for an energy infrastructure business? I would identify the assumptions with the greatest uncertainty and financial sensitivity, such as demand, inflation, interest rates, project timing, commodity prices, or regulatory outcomes. I would define a documented base case, then build upside and downside scenarios with internally consistent assumptions rather than changing one variable in isolation. I would quantify impacts on earnings, cash, capex, and leverage, explain probabilities where possible, and identify trigger points and mitigations. Scenarios should help management prepare, not pretend to predict perfectly. Focus on identifying uncertain drivers, constructing base, upside, downside cases, using sensitivities, modeling interactions, explaining probabilities, and linking scenarios to decisions, mitigations, and trigger points. Question 23. How would you collaborate with operations, project managers, and accounting? I would build relationships through regular, focused conversations rather than contacting stakeholders only when numbers are late. With operations, I would understand the activity drivers. With project managers, I would review milestones, commitments, risks, and estimates. With accounting, I would confirm treatment, cutoff, and ledger integrity. I would agree definitions and submission dates up front, translate finance questions into practical terms, and close the loop on issues. That approach produces better forecasts and makes finance a credible business partner. Be sure to mention translating finance requirements, understanding operational language, agreeing definitions, validating estimates, respecting accounting controls, regular communication, and resolving differences through evidence. Question 24. What would you do if actual results did not reconcile to the general ledger? I would not distribute the report until I understood the difference or clearly disclosed it. I would check the reporting period, source extract, account and cost center mappings, eliminations, manual journals, currency treatment, and any late postings. I would compare totals at each aggregation level to isolate the break, then work with accounting to determine whether it is a timing issue, classification error, or genuine data problem. Any correction would be documented, approved, and retained with a clear reconciliation trail. In your answer, cover stopping distribution, checking source extracts and mappings, identifying timing or journal issues, documenting adjustments, involving accounting, and preserving an audit trail. Question 25. What would success look like in your first 90 days as a National Grid FP&A Analyst? In the first month, I would learn National Grid's business structure, regulatory context, systems, chart of accounts, reporting calendar, and key performance drivers. By 60 days, I would independently deliver recurring analysis, build relationships with budget owners, and understand the assumptions behind major forecasts and projects. By 90 days, I would be a dependable contributor to the forecast and management pack, with one practical process improvement identified and implemented. I would measure success through accuracy, timeliness, stakeholder feedback, and clearer insight. Make sure to cover learning the business and regulatory context, understanding systems and reporting cycles, building stakeholder relationships, delivering accurate work, identifying process improvements, and setting measurable priorities. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.